Once we find a good entry point to buy a call option, then the question becomes which strike price do you use once you've selected a stock that you're going to purchase a call option. So we use what I call the 1% rule to select an option strike price with a high probability of success. And this is a very simple rule of thumb, very easy to calculate, but it allows you to get to select an option strike price that has a high probability of success. And once you select a trade, an option trade, there could be hundreds or even thousands of strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. So with option basics, we know that option premiums consist of time value and intrinsic value. And of course, options, they lose all time value at option expiration. So when you buy an option, you're buying a decaying asset. So you always want to keep that in mind. And due to the time decay characteristics of options, when we buy an option, we want to minimize the time value because that's going to decay to zero at expiration. And we want to maximize the intrinsic value because the option will always keep its intrinsic value at option expiration. So we want to minimize the time value, which decays to zero, and maximize this intrinsic value, which remains at option expiration. So we've come up with a very simple rule of thumb. We want to limit the time value portion of an option to less than 1% of the stock price per month. And if you do that, that'll allow you to minimize the time value and maximize the intrinsic value. And here's an example of the math on this. If you, let's say we purchase a 1 month call option on a stock that's trading at 100. So if we want to limit that time value to 1%, in this example, you'd want to limit the time value portion of that option to 1 point or less. And that would equal 1% of the strike price per month. So if we're trading a stock at 100 and we limit that time value portion to 1 point, that's 1% of the stock price per month. And if we purchased a 2 month option that was trading at 100, then you'd want to limit the time value portion of that option to 2 points or less, and that would equal 1% of the stock price per month. So 2 points divided by 100 equals 2%, divided by 2 months equals 1%. So the goal is to limit the time value portion of an option to 1% of the value of the stock. Now, if we do that, then the stock only has to increase 1% in price in order for that trade to break even and start making money. So if you limit that time value to 1%, you're going to have a much higher probability of being profitable than an option strike price that requires, let's say, a 6 to 10% increase in the price of the stock to break even. So with this rule, the stock only has to go up 1% and we start making money. And let's look first at an example of an out-of-the-money call purchase. And we don't purchase out-of-the-money options, so I don't have any real examples for you. So I have to use this is a price, an option chain for Priceline stock. At the time, it was trading at 1162, and we're going to look at buying the 1270 strike call option. So if we select the 1270 strike call option and the stock is trading at 1162, that would be an out-of-the-money example of a call option. So the way we calculate the break-even price on a call option purchase is we take the strike price, in this example, $12.70, you add the premium, which is $12.60, and that, if you add those two together, you get the break-even price for that call option trade. So in this example, the break-even price for Priceline stock would be $12.8260. So with the stock trading at $11.62, in order to break even on this trade, it would have to increase 120 points to $12.82. So it has to go up 120 points in order for this trade to break even. And that translates to a 10.3% up move in the stock in order for this trade to even break even. So a lot of times you're not going to get this 10.3% up move in the stock. And if you have a call option and the stock is flat or goes down, you're going to lose 100% of your investment. So that's why we don't like to trade these out of the money options. We'd much rather trade in the money. We have a much higher probability of success. So here's the call option purchase calculator for this trade, and this is assuming Priceline stock trading at 11.62. We buy the 12.70 strike put, or 12.70 strike call, and it cost us 12.60. And we can see that the call option purchase calculator also, by the way, will calculate the time value and the intrinsic value. In this case, the time value is 12.60, and this call has no intrinsic value. So we can see that even if Priceline is up 5% at option expiration, we're still going to lose 100% of that premium. If it's flat, we lose 100%. If it's down at all, we lose 100%. So this would be a low probability trade, and if that stock doesn't go up 10.3%, we're looking at a total loss of our option premium. So let's now look at an in-the-money call purchase, and we'll see what the profit potential is for trading these in the money. So here's my brokerage transaction report, and this is for that Cigna call option that we discussed. Cigna was on a prime trade select buy signal. So before I purchased this call option, I ran this into the call option purchase calculator to figure out what the intrinsic value was and what the time value was, with the goal of keeping the time value to less than 1%. So the transaction shows that I bought the Cigna July 50 strike call at 17. And at the time, Cigna was trading at, the stock was trading at 66.71. So the call option strike of 50 was less than the price of the stock, so this would be considered an in-the-money strike. So let's look at the call option purchase calculation for this call option trade. Again, Cigna stock was trading at 66.71. I bought the 50 strike call at 17, and we can see the time value portion of this option was only 29 cents, and the intrinsic value was 16.71. So this was almost all intrinsic value. And with the time value of 29 cents, the advantage of this trade is Cigna stock only has to increase 29 cents or 0.4%, and this option trade will break even and start making money. So we can see that with in-the-money call purchase, of course, you have less leverage, but we can see that if the stock goes up in price, we'd still get a good return. We can see if Cigna stock goes up 20%, we're going to have a 76% return for the option. If it goes up 10%, we're going to have a 37% return on the option. So even though this is in the money, we'll still get a good return if the option goes up in price. And we can see if the stock just stays flat at 66.71, we're only going to lose 1.7%. So what we're doing here is we're reducing some of the leverage, and we get a less return potential, but we can see it's still a very good return potential if the stock goes up. And again, with 29 cents of time value, the stock only has to go up 29 cents, and we start making money. And in this example, Cigna closed at 77.84 at expiration. So we actually closed out a 63% return for this option. So the in-the-money call purchases have a much higher probability of success compared to at-the-money or out-of-the-money call purchases. And again, with 29 cents of time value, the stock only has to increase 0.4%, and this trade will break even and start making money. So I'm going to have a much higher probability with this trade compared to, let's say, that Priceline trade where the stock has to go up 10.3% in order for me to just break even on the trade. So a lot of times stocks, they're not going to make that expected move prior to option expiration. So that's why you want to buy these in-the-money calls that are have less leverage, still give you a very good return if you're right, but if you're wrong, you're going to lose a lot less. So you're going to have a much higher probability of success using these in-the-money call purchases. So let's look at part two, which is our trade management. And once we enter a trade, then we use these three trade management rules to manage the trade. And the first rule we use is the 30% rule for walking away. Rule two is we use the 30% rule for protecting profits, and then we roll over it at expiration if the stock is still on a prime trade select buy signal and the trade is profitable. So prime trade select helps us select a stock and gets us a low risk entry point using the Keltner channels. Then we use that 1% rule to select the option strike price with a high probability of success. And then we use our trade management rules to manage that trade. And the net result of the prime trade select and using the trade management is high accuracy option trading, and the whole goal of that is to avoid those big losing trades. Okay, rule number one for the trade management is we use the 30% rule for walking away. This is just a simple stop loss rule, and if an option's price drops 20% below our entry price, we will start looking to exit that trade before you incur a 30% loss. So the whole goal of this trade is not to incur 100% loss with your option trade. It's hard to make up for 100% loss. So the goal is we use this simple money management rule, and we'll start watching it. If the price drops 20% below our entry price, we'll definitely exit before it hits 30%. And here's an example. In this transaction report, I bought the J&J January 80 strike call at 23.72. So once we establish our option trade, we'll just monitor it. I usually just look once a day at the positions and to take a look to see how they're doing. And if we start to develop a loss on a trade, and then we'll start looking to exit that trade before it develops into a big loss. So in this example, if we paid $23.72, if the price of J&J, if the price of the option, we bought it at $23.72, if it drops down to around $18.98 or $19, that's a 20% loss of our premium. So if it drops 20% from this entry price, then we're going to make a mental note to exit that trade if the option drops 30% from our entry price. In this case, if it got down around 1660, that would be a 30% loss, and then we'll simply exit the trade before we get to that 30% loss, and that helps prevent those really big losing trades, 80, 90, 100% loss, which are really hard to make up. So this helps prevent a total loss of our option premium and allows us to move on to the next trading opportunity, because we still have some trading capital left.